Federal Reserve Chairman Jerome Powell is signaling the central bank will not waver from its aggressive approach to fighting inflation.
The Federal Reserve's next meeting will take place less than 2 weeks from today. Powell said Thursday the Fed is determined to, quote, keep at it until the job is done. Economists are expecting another 75 basis point hike to be announced later this month. Now, it would be the third time this year rates see a 0.75 point increase.
And joining us now is William Lee. He is the chief economist for the Milken Institute. William, thank you very much for being with us.
Thanks for having me.
So you believe lowering inflation largely depends not on the actions of the Federal Reserve as they are, but on how they are perceived by Americans. Can you break down how that works?
You have to remember that an economic system is not like physics. The laws of economics and behavior in economics is very adaptive, and people adapt to how they perceive the future is going to be evolving. And so if people think that there's going to be a lot of inflation, that means they're going to try to get ahead of it. Wage demands will go up, prices will try to go up in anticipation of costs going up. But if the Fed can tell everyone, look, we are determined to bring that inflation rate down to 2%, and we're going to do it in a reasonable amount of time, then if people are really convinced of that, they won't be pushing for 5, 7, 8% wage increases or 9, 10, 11% price increases. Instead, when you get a new apartment lease renewal, it'll be 4%. That's the key to the Fed's policy working quickly without having to go through a very severe recession.
Well, economists believe the Fed will likely raise interest rates again this month. What do you think Fed officials should do to best sell this potential decision to the public?
Well, the Fed has lost so much credibility with the financial markets and the public in general that they really have to say, look, you believe that the public seems to, and financial markets believe that the only way to lower inflation is by having a severe recession. So we're going to be doing that. We're going to raise rates until we see inflation come down. Now, once people say, wow, if I'm going to get laid off in the next 6 months, I better start saving. Then people start to stop their spending and start to save more. That in itself reduces the demand for goods and services, that pushes up prices. So to the extent that people believe the Fed will be pushing us into a deep recession, they're going to stop spending and they're going to start saving. That's the key to lowering inflation. And so once inflation comes down, the Fed will turn out that they will not have to raise rates to 4, 5, or 6%. Maybe keeping it at 3.5 for a while will do the trick.
So much of this is about the psychology of consumer spending and consumer behavior. William, if the Fed does stay on track with its current aggressive approach to fighting inflation, how long until we can expect to see costs diminish?
There are two scenarios. If the public says, look, we don't believe you, we think you're going to cave in the minute the unemployment rate starts to rise, then the Fed is going to really have to push rates up the way Volcker did, maybe to 4.5, 5, perhaps even 6%. And that will crash the economy probably in the next 6 months to a year. But if people actually believe the Fed and they start to lower their wage demands, lower their price increases, then we'll see the benefits start to occur easily in the next 3 months, 4 months.
Wow, the power of perception. William Lee, thank you so much for joining us and sharing your insights with us. We appreciate it.